Hello fellow compounders. In this video, we'll discuss 6 potential businesses that you could add to your income producing portfolio. Also, we'll review the concepts of earnings yield, dividend yield, shareholder yield, and total return. And at the end of the video, I'll show you how those 2 portfolios compare to their passive investor counterparts. Welcome to the Always Be Compounding Club, where we share ideas on how to build, grow, and enjoy wealth. I'm your host, Dennis Chen. Welcome aboard. Let's get started. The businesses we'll be reviewing are JP Morgan Chase, Simon Property Group, Hanesbrands, Comcast, Verizon, and Intel. Let's put this video into context. If you've been following our channel, you probably know that we've segmented investors into 3 camps. Number 1, the defensive or passive investor. Number 2, the active or enterprising investor. And the 3rd camp are the conflicted or in-betweeners. They're between the passive investors and the enterprising investors. Today we will be reviewing individual stocks for the enterprising investors, dividend portfolio, and total return portfolio. Remember that in a previous video I showed you that both the dividend and total return portfolio can be used as income producing portfolios. You can see that video in the link right here. Before we start talking stocks, let's review what is earnings yield, shareholder yield, and dividend yield. If you already know them, skip to the next section of the video. Earnings yield. Earnings yield is the amount of money earned by a business divided by the price paid for the business. In our case, earnings yield is our earnings per share divided by the price of the stock. It is the inverse of the price earnings ratio. For example, if you have a business that earns $10 and you paid $100 for it, then its earnings yield will be 10%, which is $10 earnings divided by $100. Dividend yield. Dividend yield is the amount of money a business distributes to its owners, divided by the price paid for that business. So if the business or stock pays $5 per year in dividends, and you paid $100 for the stock, then the dividend yield is 5%, which is $5 dividends divided by $100 that you paid for the stock. Shareholder yield is the amount of profits that a business distributes to its owners divided by the price paid for the business. This distribution can be made in the form of dividends, share buybacks, and debt reduction. For example, if the price per share of a business is $100 and it pays out $2 per share in dividends, it uses $3 per share for buybacks, and it pays down debt equivalent to $2 per share, making the total distribution $7. This means that the shareholder yield is 7%. If you had to choose between this business that has a shareholder yield of 7% and a dividend yield of 2%, and another business with a dividend yield of 2% and no other forms of profit distribution, which one would you choose? One last definition: total return. Total return is what an investor would make from dividends received plus capital gains. Capital gains is the difference between what was paid for the stock and its current price. Dividends are straightforward, is what you receive in cash. Earnings, share buybacks, and debt pay down should be reflected in the capital gains. So why all this preamble? We need to know these concepts to use as filters to pick businesses we'll use to build either the dividend portfolio or the total return portfolio for the enterprising investor. Let's start. What should be our goal when screening for the stocks? As enterprising investors, we would like to do better than our passive investor friends. This means that we should set a hurdle rate for stock candidates. So let's use BOO, which is the Vanguard S&P 500 ETF, and SHD, which is the Schwab US Dividend ETF, as benchmarks. BOO is what a total return focused passive investor would probably own, and SHD is what a dividend focused passive investor would own. The dividend yield of BOO currently is around 1.65%, and its earnings yield is 5.5%. So we are going to be looking for stocks that can beat that. On the other side, SHD has a 3.4% dividend yield and an earnings yield of around 7.3%. If your stock selections or our stock selections can't beat the ETFs of a passive investor, we're better off just buying the ETFs. Quick disclaimer, this video is not financial advice. It is my opinion and it is for educational purposes only. You're responsible for your own financial decisions. Please do your own research or consult your financial advisor. Now let's run down our list of 6 candidates. Number 1, JP Chase, symbol JPM. JP Chase is the nation's largest bank. Its competitive advantages are scale, reach, and diversification. It has a traditional lending and credit business. It also is a powerhouse in capital markets, corporate lending, investment banking, and asset management. These advantages allow for industry-leading margins. This paired with a fortress balance sheet gives the bank awesome financial stability. This is a premier business that pays a dividend yield of 3.55% and has a shareholder yield of 8.27%, which is much better than leaving your money in a savings account at a bank. JP Morgan has an earnings yield of close to 12%, and at around $112, it's selling for 25% discount to the fair value estimated by Morningstar. I think this bank is a great candidate for both the dividend and total return portfolios. Number 2, Simon Property Group, symbol SPG. Simon Property Group is the second largest real estate investment trust in the United States. Its portfolio includes an interest in 207 properties composed by 119 traditional malls, 69 premium outlets, 14 mill centers, 6 lifestyle centers, and 5 other retail properties. SPG's properties average sales of $693 per square foot over the 12 months prior to the COVID pandemic. The company also owns a 21% interest in Klépierre, which is an European retail company with investments in shopping centers in 16 countries, and joint venture interest in 33 premium outlets across 11 countries. SPG pays a whopping 7.16% dividend yield. Because it's a REIT, it has to pay out most of its earnings. It pays more dividends than SHD or BOO. And at around $95 per share, it's selling at a 41% discount to the fair value estimated by Morningstar. This is a great candidate for both the dividend and total return investor. Number 3, Hanesbrands. Do you remember Michael Jordan's commercials? Hanesbrands owns several well-known brands including Hanes and Champion, and has a global manufacturing footprint. These assets should enable the company to respond well to shifting consumer retail habits, continue cost-cutting, and find attractive acquisition targets. Acquisition activity and the loss of retail partners to bankruptcy during the COVID pandemic has hurt the dividend growth recently. However, Hanes pays a hefty 5.8% dividend yield, and when you include that with the share buybacks, it has a 6.5% shareholder yield. Currently, at a price of $10.29, it's selling at around 60% discount to its fair value estimated by Morningstar. This is the cheapest stock on the list, and it's a great candidate for both the dividend and total return portfolio. Number 4, Comcast, symbol CMCSA, that's Charlie Mexico, Charlie, Sierra Alpha. Comcast holds a dominant position in the internet access market and also owns solid media and entertainment assets in NBC Universal. Don't you like to go to Universal Studios and visit Harry Potter's Wizarding World? I know I do. Getting back to Comcast, its increasing broadband revenue more than offsets the legacy video service runoff. In addition, the company is investing in its streaming service Peacock to offset the video subscriber losses. Its strong balance sheet and low payout ratio should allow for rapid dividend growth. Comcast has a 2.75% dividend yield and a shareholder yield of 5.71%. At a price of around $39 per share, Comcast is selling at a 35% discount to the fair value according to Morningstar. Given that its 2.75% dividend yield is less than SHD's, Comcast will not be a candidate for a dividend portfolio, but it is a good candidate for a total return portfolio. Number 5, Verizon, symbol VZ, Victor Zebra. Verizon has held up well against stiff competition from AT&T and T-Mobile. which is a testament to the reputation and quality it has built over the last 15 years. The business has also proved essential during the COVID-19 pandemic. However, the competition remains intense, which limits pricing power and growth. Expansion and growth through next-generation 5G technology is a wildcard. Verizon has an earnings yield of around 10% and is a very consistent dividend payer with a 5% dividend yield. Currently, at a price of around $51, it's selling at a 14% discount to fair value estimated by Morningstar. It is a good candidate for both the dividend and total return portfolios. Last and not least, number 6, Intel. Who doesn't know Intel? Remember Intel Inside? Intel is the world's largest chip maker. It designs and manufactures microprocessors for the global personal computer and data center markets. Intel pioneered the x86 architecture for microprocessors. The firm has recently faced manufacturing delays causing the stock to tumble. While Intel's server processors business has benefited from the shift to the cloud, it has also been expanding into adjacent markets as the personal computer market has stagnated. These include areas such as the Internet of Things, artificial intelligence, and automotive. Intel has also been active in the M&A front, acquiring Altera, Mobileye, and Havana Labs in order to bolster the efforts in the non-PC arenas. At a price of around $37, it has a dividend yield of 3.9% and an earnings yield of around 16%. It's trading at 42% discount to the fair value estimated by Morningstar. It is a great candidate for both the dividend and total return portfolios. Before I conclude, let me sincerely thank you for watching my channel. This is our 14th video and I'm really enjoying creating videos for you. If you've got value from this video, please subscribe and let me know in the comments below by placing the words "I've subscribed." Or if you're already subscribed or you're already a subscriber, please hit the like button and place in the comments below the words "adding value." I really appreciate it. It helps the algorithm and helps support the channel. Now, let's take a look at the portfolios. For the total return portfolio, if you bought all 6 stocks in equal proportions, you would have a portfolio with a shareholder yield of a whopping 6.2% and a dividend yield of 4.7%, which is almost 2 times the 1.65% paid by VOO. And you will also have earnings yield that are 2 times higher than VOO. That's a portfolio I'd like to own. For the dividend portfolio, if you bought the 5 stocks that pass the screen in equal proportions, you would have a portfolio with a 5.1% dividend yield, which is 50% more than the 3.4% yield paid by SCHD. And you will also have an earnings yield that is 59% higher. Not bad for being an enterprising investor. So there you have it. Some great candidates to build an income portfolio for either a dividend or a total return focused investor. Thanks for watching. Remember to always be compounding. Take care. So long.